Why are whispers of possible interest rate drops not turning into a reality until late 2024? Canada finds itself in a tight grip of inflationary pressures that stubbornly refuse to ease, challenging the hopeful forecast of many. Peter Dungan, an economic expert, shines a little light on the situation, explaining the inflation we hoped was temporary blip that dug its heels in, spurred in by factors like the global upheaval caused by Russia-Ukraine conflict that nobody could have predicted back in mid-2021, and every other war or world complication today. This has led the Bank of Canada to adopt a stance of vigilance, holding interest rates to a higher threshold to ensure the economy finds its balance again amidst these persistent challenges. For home buyers and current property owners, this means navigating a landscape different than what we have seen the past couple of years. A complex cocktail of global geopolitical tensions, lingering supply chain woes, and the aftermath of hefty economic stimulus measures, all stirring the inflation pot more vigorously than anticipated. As rates hover above the 4% mark, far from the pandemic-era lows, the reality sets in. Securing or refinancing a mortgage will cost more for longer, impacting affordability and investment decisions. Interest rates in Canada are unlikely to decrease until Q4 of 2024 due to the Bank of Canada's cautious approach in managing economic recovery and inflation. The unexpected hike to 4.75% in June of 2023 reflects a strategy to avoid past mistakes of maintaining too low rates for too long, which limited the bank's options during pandemic's onset. This move indicates the deliberate effort to provide more flexibility in monetary policy and prevent a repeat of the conditions that led to prolonged low interest rates post-2008 financial crisis. Interest rates in Canada are expected to remain above the 4% for the foreseeable future, moving away from the historically low levels seen during the pandemic. This adjustment strategy in the Bank of Canada aims to provide flexibility for future economic interventions, signaling the end of the era of the rock bottom rates outside a serious recession or emergencies. This new baseline anticipates a different economic landscape where the higher interest rates become a norm rather than an exception, requiring adjustments in expectations for inflation management and economic growth strategies. The Bank of Canada's cautious trajectory, aiming to prevent the past mistakes of too low rates for too long, signals a new era of economic strategy. With interest rates projected to stabilize at a higher baseline long term, Canadians are looking at a future where higher rates are the norm, not the exception. This scenario poses a critical question for both prospective home buyers and current homeowners. How will this affect your financial planning, and what strategies can you employ navigating this period of economic recalibration effectively? Don't forget to subscribe for all your Canadian real estate investing tips and tricks, and to help build wealth with each and every real estate transaction, even in today's economy.